Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back and kick up your feet because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Hello, Laurel, Alabama. Hello, Gulf Coast. Welcome in. Welcome to Coasting in Retirement. That's right. Thanks for joining us today. Josh Knoll here, joined by the one and only Michelle Lee Melton.
Howdy.
Michelle, how you doing?
I'm doing well. Just finished up a 5-night run of Grease on the Bluff here in Fairhope.
How was it?
It was wonderful. You were there.
I was.
I mean, it's different from when you're in it than in the crowd, but people seem to have a great time, and it was a lot of fun.
A lot of
work. And no rest for the wicked, because I have a tap recital this weekend.
That's right. Here it comes. Well, we are back in Coastal College's recording studio, beautiful downtown Fairhope, ready to put on another great show for those of you tuning in.
All right.
Listeners, Michelle and I are here today to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. Here's what we got in store. First segment, deep dive on our topic of the day. Second segment, about 30 minutes past the hour, Michelle with the news headlines of the week. Mm-hmm. And then roughly 50 minutes past the hour, stick around for our third segment. We call it Josh's Crystal Ball and Big Mouth. So buckle up. We got a lot to get to. Quick background on me for those of you new to the show. Again, my name is Josh Knoll. I'm a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That's a 100% locally owned, 100% independent investment management and financial planning firm. We have offices in Fairhope, Orange Beach, and Mobile. You can find more information on me and the team at Gulf Coast Financial Advisors by visiting our website, gulfcoastfa.com, or feel free to give us a call at 251-327-2124. Now, if you just missed that, do not worry. Grab a pen and pad. We're going to repeat it several times throughout the show. Now, before we get to our main topic, Michelle, we have a huge favor to ask of our listeners, right? For the second year in a row, this show, Coasting in Retirement, has been nominated for what's called a NAPI Award.
That's right.
Which is a series of awards across many, many different types of businesses. It's put on by our local beloved weekly Lanyap, which took me forever to figure out how to pronounce that, because how it's spelled and how you pronounce it are two different things.
Right. It's French. It means a little something extra.
There you go. All right. We're one of 6 finalists in the Best Radio Lifestyle Shows
Yeah,
category,
we are.
Right. And this time, we were nominated last year. We were just happy to be there. This time, we're coming to win.
That's
baby.
right.
Yeah. And to win, we need your all's help.
Yes.
Please visit votenappies, NAPPIES.com. And if you would, go to the media section. Look for us under the radio lifestyle segment.
It's the first one.
And vote. Yes, please. You can vote once per day per email.
That's right. Through June 1st.
Through June 1st. And I am proud of the fact that, as far as I can tell, I know in our segment we're the only financial show nominated, but I think we're the only financial show nominated, period.
I think so.
Yeah, I looked everywhere. I didn't see any other financial shows. Not that they're not good competition, but we were the only one nominated.
That's right.
And we've been on the air for 2.5 years, which has gone fast, to be honest with y'all, but we're still the baby of the group. So I mean, it tells me we're doing something right.
Sure.
So
thank you, listeners, so far, and we need you to keep it up.
That's right.
Vote every day, different emails.
So whatever reason that you all listen, we would really appreciate your vote. We'd love to be part of that ceremony. It's for the area, it's about as good as it gets for this type of award. We're happy to be nominated again, but we want to win.
Yeah.
All right, so let's get on to the show.
Okay.
All right, Michelle.
Yes.
Do you like roller coasters?
I love roller coasters.
What's your favorite thing about them?
Speed, corkscrew turns, and the dramatic drops.
Yes, you do love that.
Yes.
Do I like roller coasters?
You're scared.
A little bit. Kind of like planes?
Yes.
Yes. I don't, when it comes to roller coasters or airplanes or anything, handmade machines, that if they fail, I end up probably dying. I'm not a huge fan.
Yeah, but you get in a car.
I do, but I have more control. You notice I always drive.
That's true, you do, but there's other people on the road.
It's fair. Well, all right, so would you ever go to an amusement park and not ride at least one roller coaster?
Most likely not. They'd have to be in really, 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 really bad shape, because I've ridden some that go over the ocean and they're salt-ridden and stuff. So
Right. Yeah.
And I survived.
Yes. Well, and I, as opposed to me, I'm perfectly fine tootling around all day, Silver Dollar City, back where I'm from, or Six Flags. And
Nobody knows what he does all day. We're riding roller coasters and carrying on, but
I'm just going out and meeting the people,
are you?
meeting the general public.
You know what? You wrote that water one though. Remember it had in Missouri it had the ballyhoos or whatever those that
who
wore the
knows?
stockings on their heads and robbed everybody.
The bald knobbers.
Yes.
Yeah, the old bald knobbers.
That's right.
Yes, Branson, Missouri. So what I'm going to do today, or I'm going to try to translate Michelle and I's different roller coaster approaches to how investors view the stock market. And just stick with us, listeners, it'll make sense. I'm also going to explain a concept for those of you that are like me and don't particularly care for roller coasters, especially for those of you that don't think you can stomach the extreme up and downs of recent stock market volatility. One of Michelle's favorite words.
Yes.
So let's do this. Let's start with Michelle's approach to roller coasters.
Okay.
Michelle has stated that she would not go to an amusement park and not ride at least one roller coaster, right?
Correct.
She doesn't want to miss out on the ride.
Love it.
You would be disappointed.
Yes.
Yeah, you'd be wandering around all day wondering when you're going to ride a roller coaster.
Well, they make me laugh maniacally out of control. I love it, especially when you go upside down.
This is true. I've been next to you on that.
Yeah.
Now, while Michelle is never going to trample people to get to the front of the line of a
not gonna do
roller
that.
coaster, she's not that anxious about it. There is a concept in the investing world that is kind of similar to what is called fear of missing out,
FOMO.
commonly known as FOMO, right?
Yeah.
In fact,
My puppy has that.
it's well enough known that the Oxford Dictionary defines it.
That's right.
It's defined as anxiety that an exciting or interesting event may currently be happening elsewhere.
Oh no.
Which is the implication that you're missing out.
That's right.
Fear of missing out. On the bad side of FOMO, fear of missing out, it can lead to impulsive decisions.
Yeah.
So we're going to pivot to investing. It can lead to impulsive decisions by investors because they see people, often on social media, supposedly making large profits on some type of unique investment. I coined a sister term that Michelle likes called FOLO, which is fear of looking old. So some of you all that listening, a lot of you listening, you just like Michelle and I, you grew up in a very different time regards to technology investing. And sometimes you see a young person hyping the deal of the century, and you don't want to be old or stodgy or feel like you're out of date, and you wonder if your apprehension is just because that maybe it's something you don't understand. Well, sometimes that's true. A lot of times it's not. We're going to talk about it. In my adult life, there have been 5 investing strategies off the top of my head that have played on this fear of missing out / fear of looking old that investors have. The first happened when Michelle and I graduated from college in the late 1990s. We had the .com boom and bust, right? And then to a lesser degree, didn't get as much press as the .com bust, but it was a kissing cousin to that whole time period, the penny stock phenomenon that eventually produced criminals like the Wolf of Wall Street guy. I think his name's Jordan Belfort, right? The next FOMO event was the real estate bubble of the early 2000s. I know this for a fact because
You lived it.
I didn't have fear of missing out. I was in the middle of it. And once we cleared that real estate bubble burst and we entered into a prolonged era of cheap money, and plus we had increasing social media presence and obviously ever-increasing computing power, that eventually led rise to the most recent FOMO type of investments. Yes, I'm talking cryptocurrency, and shortly thereafter, artificial intelligence or AI. So, .com, penny stocks, real estate, crypto, AI. Do you see any trends there, any common threads there, Michelle?
I feel like they were propagated by white males.
I wasn't expecting that. It is heavily young and male dominated. We're going to talk about that. And I'm telling you right now, if you know me in the 2000s, I sounded just like the rest of these knuckleheads.
Sure.
Right.
I wouldn't have known you.
That's fair. Are there another question for you. Are there any similarities? You just mentioned it, how these various industries were and are hyped by typically young, typically male, investing wannabe profits. Absolutely, right?
Yeah, I mean, you're one of them.
How the message has been consistent that if you don't invest in these various opportunities, that somehow you're dumb or you're uninformed or you're outdated, or heaven help us, that you're missing out on the next big thing, right? FOMO.
Right.
I tell you, listeners, another common theme across these various investments is that more often than not, actually every time so far, AI is still playing out, but more often than not, a small number of investors got one big, I mean huge, right? We're seeing that right now with crypto. But the far, far larger number, off the top of my head, 80-90% of the people that got into them lost their behinds.
Mm-hmm.
And yes, Crypto Bro and AI Honk, I realize that your story has not been fully written yet. And that for right now, you are absolutely winning the day. I mean, there's no argument with that.
Crypto I don't know if that guy Friedman, whatever, is winning
well,
right
he's
now.
Not winning. But Michelle, I didn't tell you this. This got announced within the last 24 hours. Coinbase, which is a crypto exchange, just got added to the S&P 500.
Oh, okay.
Now,
well, look at that.
This is important to you investors because the S&P 500 is probably the most common index fund. And when you own an S&P 500 index fund, that means you own in a similar percentage a piece of the 500 companies that are in that S&P 500. So guess what? All that have an S&P 500 index fund, you are now part of the crypto game, whether you like it or not.
Yeah, good or bad. Yeah.
Now, Crypto Bro is going to hype this as a huge win, and it is. It's probably going to add somewhere in the neighborhood, estimates are add $10 to $15 billion worth of market capitalization to Coinbase, which not that long ago was under investigation.
Sure.
But it's important to know, Coinbase, folks, is an exchange. I don't know them well enough to tell you if they actually issue their own coins, but I don't think that's the business they're in. The majority, if not all of their revenue, is from helping people facilitate the buying and selling of crypto tokens, coins. So think of Coinbase as kind of like the shovel and pick supplier in San Francisco for the gold rush. That's
okay.
All right. And that's all, in my opinion, historically, that's the side of the equation you want to be on, not in the necessarily out there chasing for the actual gold. So the thing is, you all are winning today, but Uncle Josh has seen this story before. Are there opportunities to make money with these types of investments? Of course. I mean, I made millions in the 2000s in real estate. I mean, you know what else I did? I listened.
You lost it.
I lost it, and probably to some degree because I listened to charlatans like the Rich Dad Poor Dad guy that Robert Kiyosaki, and just like I'm seeing right now with a lot of investors, I ignored the basic fundamentals of investing. Yet in my particular case, and a lot of Rich Dad Poor Dad followers, even then and probably now today, I was leveraged to the hilt and eventually sank me, like Michelle said. So my job as a seasoned and skeptical financial advisor is to use this real world experience and help and keep this nonsense from sinking your all's investment portfolio. I don't know if there's a perfect percentage of a client's investable assets that need to go in these products. Off the top of my head,
zero.
Well, not necessarily. I mean, I would say somewhere in the 10 to 30% range. I think would be
up to 30
would be common sense depending on the investor.
All right, I would think 10 at best.
Or like you said,
but I'm not a professional.
A lot of times the answer is zero, but these guys will push it all the way up to 70, 80%.
Whoa!
Right. So, again, they do this to an absurd level, and the problem is, Michelle, is that they do it again when the surrender period is over. They basically place a new product in the portfolio mix.
Okay.
And
what you have to have.
What that does is, no, you do not. You can carry.
I'm just kidding.
Right.
That's what they tell you.
Right. And it can generate yet another large upfront commission. It's lather, rinse, repeat. All right. Now, fortunately, for those of you listening, there's a way to move forward without dealing with these two extreme approaches, both FOMO and total fear. There's a way for you to participate in the stock market or ride the roller coaster, if you will, without fear of getting slung off the rails and crashing to the ground. My particular fear, by the way. What if I could pay a little extra for my roller coaster ride, a little extra on the top of the price of the ticket that accomplished two things? One, whenever the roller coaster is plummeting down, I could flip a switch and the roller coaster would pull up before the bottom of the drop, say 20 feet short.
Okay.
And in exchange, all I had to do was give up a little bit of the height that the roller coaster cranked me up to, say maybe 5 feet in this example, right?
Okay.
In other words, what if I could ride the ride with my fellow investors, but my ride was just a little bit smoother, almost as high, but certainly not nearly as low, with less difference between the two extremes, which savvy investors will understand, that is volatility. Would I like that, Michelle?
Yes.
Would I buy that?
Probably.
Yes, I would. So what I just described to you all, now little side note here, what I described to you all is hedging in the investing world, where you do something that helps when the market drops, that actually has a plan when the market is dropping. In exchange, there's a sunk, non-correlated cost to it on the top, which means you're going to take a little bit of gravy out the top in order to buy these things. But and even with that, it's all investing involves risk for sure. The main thing I want you listeners to take a couple of things away from how I've used the roller coaster as a metaphor or again, not an allegory, as Michelle said. In our example, even though I am using an hedging option to stop 20 feet short of the bottom of the coaster drop, I am still dropping.
Right.
Because even in our portfolios, investors will experience some volatility and some drop in value when the overall market is getting beat up. The amount of that drop will be dependent on how aggressively you are invested. If you're conservatively or moderately invested, you generally speaking will not see the significant drop as you would if you're in a growth or an aggressive portfolio. The exchange for having that downside protection is that you still get to participate in most of the market gains when the market is increasing in value. And again, all investing involves risk. And while there are certain products that promise you 0% loss floor, i.e. see back what I was talking earlier with the annuity shops, which usually means a fixed index annuity, or in some cases there's no roller coaster at all because you don't even put your money in the stock market. For the part of your investment portfolio that needs to keep ahead of inflation and monetary growth so that you actually have an opportunity to ride the ride and experience the fun. And yeah, you ever got off a roller coaster and been, like, oh, well, that was no good. I wish I hadn't done that.
I mean, not that I wish I'd never done it, but I mean, some are better than others for sure.
But you're glad you wrote it.
Most of the time.
Most of the time. Well, I would put our system up against anybody else's approach, okay?
Okay.
Listeners, so if you've liked what you've heard so far and you want
roller coasters.
about roller coasters. Well, let's recap real quick. So,
Mr. Toad's Wild Ride.
So I'm 100% clear. The stock market, without a doubt, goes up and down. Whenever you look at any stock market chart over any number of years, you're going to see a certain trend. You're going to see the trend of up and to the right, where the overall index values of the market have increased in significant value over a course of many years. There's no guarantee that's going to happen in the short run, but over time, at least in the last 100 plus years, the stock market has shown a tendency to move up and to the right. During that, in fact, you and I did an episode here a few episodes back about the different index values since in the last 50 years.
Yeah.
And it was almost laughable.
Right, because the numbers and stuff.
Yeah, I mean, like the NASDAQ
crazy.
was 1980 was like 400 points.
Yeah.
And now I think it's back to 19,000, whatever
Yeah,
it
it's
is.
something crazy.
So
It's a lot.
the other thing you'll notice on the chart is there are dips in it. That's the roller coaster part. And we just experienced one here recently with the recent tariff announcements. And if you're somebody that panicked during that time period and jumped out, unfortunately, at least for this past week, you've seen there's been a significant regaining. In fact, we're now back in the black across all the indexes for the ones that have stayed put. Or, consequently, in our world, for not only the ones that stayed put, but also the ones that had a plan in place that was able to use our system to generate a little extra capital so that, not to take advantage of other investors, but when people were looking for the exit door and selling it at hopefully a long-term discount, we were generating extra capital in order to use that cash to put it to use. Does that make sense?
Mm-hmm.
All right. So if you're interested in learning more about that and you've liked what you've heard so far, and you want to start a conversation about your own personal investing and retirement goals and dreams, we encourage you to reach out to us. You can call us anytime, 251-327-2124, or find us on our website. That's gulfcoastfa.com. FA is in financialadvisor.com. On our site, click on the blue button in the upper right-hand corner. That will set up a meeting on my calendar. Now, I expanded the options on that recently, Michelle.
Oh.
There's several meeting choices. Right?
Oh.
It can be
a variety.
Yes.
It's a spice of life.
That's right. It can be as simple as a 15-minute introductory phone call all the way to, and it could be a 30-minute Zoom, or you can schedule a 1-hour in-person meeting at any of our 3 office locations. And remember, you can find our Gulf Coast Financial Advisors offices. We have one in downtown Fairhope. We have one in Orange Beach. It's just right down the road from the wharf, or in Mobile off the intersection of Dolphin Street and I-65. Wherever you want to meet, however you want to meet, reach out to us. We would love to talk to you. All right, folks, coming up next, there's always a lot going on in the world, particularly the world of finance, investments, and money.
Especially now.
Yes, right. Every week we scour the internet for financial articles related to our topic of the day, special articles that pertain to those of you in or near retirement. So join us after the break to hear Michelle and I discuss this week's relevant headlines in our Michelle with the Headlines of the Week segment. Stay tuned.
A multidimensional financial services company, Providence Partners serves the needs of independent insurance, financial, and employee benefit professionals. The team at Providence Partners serves other business professionals like property and casualty agencies, registered investment advisors, community banks, and benefit brokers to assist in their clients' risk management planning. Whether an individual or business owner client, this planning includes income replacement protection, planning for extended healthcare costs, family needs, and generational transfers of wealth. At Providence Partners, we give you access to industry specialists. Those specialists focus on business succession, business owner planning, family and household protection, estate planning, planning for that income loss, or planning for long-term care solutions. Providence Partners is an Alabama-based company. We have offices in Birmingham and along the Gulf Coast. Our website is providencepartners.org, and you can reach us any of the working days.
Welcome back to Coasting in Retirement. Your host, Josh Knoll here. So as we discussed before the break, every week we scour what Michelle calls the interwebs for financial articles related to our topic of the day, especially articles that pertain to those of you in or near retirement. Our job, or at least we tell ourselves it is that we want you to help you all understand how these headlines impact you, especially when it comes to your money. Now note, if you want to read our referenced articles yourself, we include the links in our show transcript, which you can find on our website, gulfcoastfa.com. Look for the podcast tab, Coasting in Retirement. We put the episodes up after this show airs every week on 106.5 out of Mobile and on 92.5 out of Foley. With all that said, and without further ado, here's Michelle with the headlines of the week.
All right, Josh, keeping with our theme, let's start with a recent headline from Morningstar titled 5 Strategies for Riding the Market Roller Coaster. This article has some common sense advice, such as playing the long game with your investments. That's my strategy. Haven't looked at mine all year, I don't think.
Your extreme case, which is awesome for your 401k advisor if he even exists.
So long game with your investments and having a diversified portfolio. I also have that. It also touches on one of the things you regularly encourage, which is to turn off the news, negative Nellies, especially financial news, which tends to hyperbolic. Is that hyperbole?
Hyperbolic, I think.
Hyperbolic, you can say that?
Yeah.
Okay. Hyperbolic in its approach and designed to produce anxiety in investors. This article also discusses tax loss harvesting, and I think of body harvesting when I was so... True story. I've lived near 2 of those places. They weren't supposed to be doing that. One in law school in Colorado and one in Chattanooga. Seriously.
Right.
Yeah, a body farm's gross. Okay, so we're talking about tax loss harvesting, which I've heard of but am not super familiar with. But hopefully it's not like body harvesting. So can you explain the tax loss harvesting?
Well, first, before I do that, I say turn off the news. Here's what I mean. Do you know, Michelle, anybody that reads more news than I do?
Reads. Politicos do.
Fair. But
Right.
I read, as far as I know, I've never met anybody that reads as wide a variety of news as I do. Now, part of that is just because I like knowing things.
Right. Sure.
But the other part is because I want to be well-versed for my job and obviously for the radio
Sure.
show. And I read from a wide variety. It's funny, everything is political at this point. So I make an intentional
Sadly,
point of,
yes.
I make a point of reading
the gamut.
because I don't know if you all know this, if you're any news nerds like me out there, but the major news sites, depending on if they're on the left or on the right, are often not even talking about the same thing. So, so if you want to see what different sides are talking about, and one thing, you have to go to a wide variety. And the other thing that you'll notice is if something breaks through and is really relevant, it'll be on
all of them.
Right. And that's kind of my little litmus test.
Yeah,
If I see it on the New York Times and Fox News, then I know that it's broken through.
Okay.
Right. Now, what I do say, I think there's probably, in my opinion, this is going to offend some people, but I don't know if there's more waste of time than watching the news. I don't know why it would be so radically different, but I can tell you that the information you will get from the written word is far more valuable than you will get from watching TV news. And that could be any spectrum. Again, I'm not trying to sound too judgmental, but for you all that have a tremendous amount of anxiety around world events, I cannot stress this enough. Turn off the news. I got that advice 15 years ago, and it was a life changer for me. I thought I would be so ignorant and missing out on all these things. He told me, read and also pay attention, and if it's important enough, you'll hear about it anyway.
Yeah.
And Eric Lucy, a mentor of mine, was so right with that. One of the best decisions I ever made was turn off the news. So we probably just lost a couple of votes with that statement, but that's my stance. Read, don't watch, all right? Then a couple other things on this article. I'm going to get to your question.
Harvesting.
Tax loss harvesting. Tax loss harvesting is a valuable tool that, as with many things in our line of work, gets oversold.
Oh.
It gets
okay.
oversold. All it means is if you've got an investment that's underwater, the IRS allows you to sell that investment at a loss and take a certain percentage of that loss and deduct it from your taxes in that current year. That's all it means. And what most people, what a lot of advisors kind of gloss over the fact is when they're trying to sell tax loss harvesting as this great tool, which it can be a useful tool, but you're limited to $1,500 per person, $3,000 per couple if you're a married couple. $3,000 is $3,000, but if you're talking about a portfolio of $1 million, you're talking kind of sometimes you're selling a position just to generate that loss when if it was a quality position, you probably would have been better off just hanging on to it, right?
Okay.
Now, and then when you do sell that, you cannot buy back the same investment within 30 days. That's called a wash sale. So you can't, there's some rules you got to follow. It is a useful tool. If you've got the most useful I've seen at the times I've used it, Michelle, is if we've got a position that it's obvious there's just no recovery. Savvy investors and also some of you advisors will recognize that for whatever reason, a few years back, probably when interest rates started rising, a lot of REITs just tanked. And now REITs are an illiquid product, so you have to go to there used to be not really much of a secondary market. You had to sell your share back to the originator of the fund, which can be problematic because if they're low on cash, they're not super excited to buy back these shares.
Yeah.
But there has been some exchanges been developed that allow for people to sell illiquid investments like REITs and the like. And so there is a little more liquidity than there used to be. And the handful of times I've used it are usually centered around that. Like when you do the research on that individual position, you realize you look at a REIT it's a way for you to diversify into real estate. And there's many, many, many quality REITs out there, and they have a purpose, and the good ones generate nice dividends and so on and so forth. But sometimes if you look at the actual holdings, because they have to actually hold some type of physical property, if you dive down into it and you realize like, oh my gosh, this ain't coming back. Right, so this is be the time. Let's get out of this thing before it gets worse. We'll carry that tax loss forward, and we'll use it to offset and get you in more appropriate investments. All right.
Okay.
Last thing in the article: rebalancing. We do that once per month. Diversification. That's something you believe in.
Yes.
You don't. Diversification is a great tool to keep you from having all losers at the same time. Now, of course, you're never going to have all winners at the same time, but it's the theory. It was originally propagated by the Vanguard guy. His famous statement was, I'm not trying to buy the needle in the haystack, I just want to buy the haystack.
Gotcha.
That's where the diversification really came into play. But yeah, good article. That was on Morningstar, a trusted source, non-political source, and non-paywalled, which is important because so many sites are paywalled now.
Yeah.
Very good. What's next?
Okay. Next up is an article titled 4 Pitfalls to Avoid When Rolling Over a 401k to an RIA. Found on... IRA.
Yep.
What did I say?
All right. I'm an RIA.
I said I did
It gets a
the
little
I
confusing.
IRA.
Individual retirement account.
Yes. Found on fidelity.com. To be honest with you, I always thought a 401k rollover was an easy thing. But after reading this article, I can see where someone could accidentally screw it up big time. I got kind of scared. The article discusses how you need to have the correct type of IRA set up to receive the rollover funds, that there could be withholding issues depending on whom the check is written to, and that some 401k rollovers often stall for no apparent good reason. And that part irritated me because it's basically saying that you have to bird dog these people to make sure they get doing their job. And you know how I feel about that.
It's more common than you think.
It's stupid. Why?
I don't know if it's.
But then it's broken. It shouldn't be common.
Well, so for example, I deal with Fidelity a lot. Fidelity in general is pretty easy to deal with.
Okay.
They got
Good to know.
They got a dedicated department.
Good.
They're pretty timely with, not always, but they're usually pretty timely. I'm not going to name the names, but there are some what's called record keepers or custodians to a normal person that just make you scratch and claw to get something out.
That's just ridiculous.
And probably one of the more aggravating things is typically with the 401k, Michelle, most people are used to doing money transactions electronically in 2025, right?
Yeah.
So if you're doing, let's say that you've got an IRA.
And you got a check made out to you? That
Yes.
seems like a real pain.
Most of them will do it.
That seems amazing, but...
We'll do a check. And okay, fine. But here's the really aggravating thing about it is they won't, unless you ask and press it, they're not going to just offer the opportunity for you to pay a little extra or them to pay a little extra to overnight or second day it with a tracking number. They're just going to send it snail mail. And I mean, I've seen these things take a transaction should take 24 hours. I've seen them drag on for months.
Well, that is dumb.
It is so dumb. And then there's a couple other things. So Michelle mentioned on this Fidelity website, not rolling into the right IRA. People get confused a little bit. So traditional IRA, there's two broad types of basic IRAs. There's traditional IRA, which / rollover IRA. It can be used either way, and there's a Roth IRA. The contribution limits for both of those accounts for 2025 and I could be wrong, I haven't looked recently, but I think it's $6,000 per year.
That sounds right.
For the traditional IRA, that's a pre-tax contribution. For the Roth IRA, that's an after-tax contribution. $6,000, and you get a $1,000 catch-up if you're 50 years or older. A lot of people get confused in that because if they're rolling their 401k, and let's say it has a value of $250,000, $500, whatever, $1 million, they don't understand those are two different numbers. There's not a limit on the amount that you can roll into a rollover IRA from a 401k. Or if there is, it's a huge limit. I've never bumped up against it. But sometimes people get the contribution limits wrong. And it's harder to do now than it used to be, but you still see it occasionally. If you have the check go to the wrong type of account. Now, usually a good custodian like Charles Schwab is going to call you immediately and say, hey, these two types of transactions do not match.
Right.
Even though the name's right, the transaction doesn't match.
It's not gonna work.
You need to set up a different type of account, and then we'll deposit the money. They're usually pretty good about that. But if you accidentally take pre-tax money, more often than not, actually, what you see, Michelle, is you see people take post-tax money and accidentally get it into a pre-tax account. Now you got a headache. You basically have to rewind everything. And then you talked about getting the check in your name.
Yeah.
Yeah. Sometimes if you're not very clear on this, they'll send the check, but they'll go ahead and take withholding out.
Yeah.
Which if it's for the long term and you don't intend to cash that check, that's a really aggravating thing because now you got to scratch and claw to get the remaining money.
Yeah.
The easiest way is if you're going to do a what's called a trustee to trustee transfer, which is a fancy name for a 401k rollover to an IRA, is you want to put the check to the name of the custodian. So, for example, I use Charles Schwab as my custodian. We instruct the 401k record keeper to write the check, we say make the check specifically to Charles Schwab and Company, FBO, for benefit of the client's name. So in your case, it'd be Michelle Lee Melton.
Yeah.
And then that way it tells this check is going to Charles Schwab as custodian for the benefit of Michelle. And then on the memo line, we always make sure we have the Schwab account number.
Sure.
Right. Now, when you do that, typically you're not going to have any problems. Sometimes people, Michelle said, we talked about how sometimes rollovers will stall. I see it, honestly, Michelle, probably the more often that I'm chasing is when somebody has a death claim.
Yeah, I've heard you talk about that
Yes,
recently.
I've had 3 recently.
Right. And
fantastic people, all 3 of them. But, man, you talk about some headaches. Because what a lot of people don't understand is when, let's say your wife dies or your husband dies, they can't just cut the check to your name out of his or her account. They first have to create an account in your name, then you request the rollover from that. So you have a true name match. And then sometimes people will do the rollover and they'll think that they're just still invested. More often than not, I've never seen an exception to this. You can do ACATs electronically. That's a topic for another day that keeps the current holdings. But more often than not on a 401k rollover, they're going to sell all your existing positions, generate cash, and then they're going to send you cash. So when you put that money, that check, and it becomes cash inside your IRA, it's just going to sit there in cash unless you or the advisor tells it to go back into the market. That gets overlooked too. So this is one of those things. One thing I forgot to bring up, Michelle, is people also need to understand, typically you do not have to take money out of your 401k. Now, in my line of work, we like when you do because then
you get paid.
Yeah, we have the opportunity to manage your account in an advisory account in a professional manner. But if I have clients listening, if you're 5+ years out from retirement, a lot of times I'll say, hey, just keep that thing and let it cook for now because the expenses on the 401k are, without exception, unless the 401k is just set up terribly, are going to be lower expenses than what you're getting into on the IRA. Because you're going from kind of a limited buffet type of investing to an a la carte, specialized, individualized plan that's going to have a little bit more baked-in expenses. But so you don't have to roll it over. Jay Stubbs always says if you're doing it, do it for the right reasons. You want that money under your care, custody, and control. I agree with that statement, but it's a conversation we have with everybody that's looking at a rollover. A lot of times people think just because they left the place of employment that they have to roll their 401k. That's not accurate. The only time I've ever seen the 401k kick the money out is if it is below a certain threshold, usually around $2,500.
They just send you a check or something?
They'll send you a check, and sometimes they'll send it without you even asking.
Right.
If you've left the employment.
I think that's happened to me in the past with jobs.
And you don't meet the minimum threshold.
Right, because I didn't work there super long. Or
they'll go ahead and kick it out. Very good.
Okay.
What's next?
Okay. Next up is, in case you didn't hear, Social Security is making the news again with recent chatter about extending the full retirement age from 67 to age 68 or later, which you're a fan of, aren't you?
Well, no.
I thought you were. I thought
No.
you said something like that recently. Like that was one of your solutions to something.
No, here's what I said.
Okay.
Great point. But thank you for bringing that up. 'Cause
Okay.
I was wondering if that was going to confuse you. What some politicians are proposing is, so right now, if you were born 1960 or later, your full retirement age for Social Security is age 67. Okay. Now, if you're
Okay.
older than that, it's 66. And I've seen some that are like 66 and 10 months. There's somewhere in that range. But let's just use 67. At 67, you quote unquote hit your full retirement age.
Okay.
Right? And what some politicians are saying, what if we moved that full retirement age back to 68 or later?
Uh-huh.
So you got to wait longer to get that maximum
Yeah.
benefit, right?
Right.
Which, of course, still increases to age 70, but that, again, is a conversation for another day. What I said was keep the existing rules in place, but right now you got to start claiming at age 70. What if you created another bracket from age 71 to 75 that was so enticing, so, such a much greater increase that if a person is willing to continue working and delay claiming their Social Security age 71, 2, 3, 4, 5 is so financially advantageous, and they're still, 60s are not what they used to be when we were kids. You know what I mean?
Yeah.
You just people in general are just more youthful now than they were 2 generations ago. So make an incentive to hang on to it, but still have full retirement age of 67. That's the primary difference between that and what these politicians are recommending, which is going to go nowhere, by the way. But keep going.
Okay. So the recent chatter is about what we just talked about with the 67 going to 68 or later, or possibly eliminating federal income taxes on benefits. I keep hearing the Social Security Trust Fund is going to run out of money in 10 years or less, which I do believe, actually. I know you don't, but I've heard it too much for it not to resonate with me, and it just seems like that's going to happen. But anyway, you're more optimistic about such things, such as Social Security, than I am. So I ignored all of the doom and gloom news headlines and found something from our friends at Motley Fool. They have a fresh off the press article titled, How to Tell If You're Ready to Start Collecting Social Security. Just like with 401k rollovers, I always thought deciding when to start Social Security was a fairly simple process. But it's not. It turns out there are a lot of pitfalls and there are a lot of potential mistakes that can be made when claiming benefits, not even taking consideration that there might not be any benefits at all.
So we're going to address that. So I'll circle back to that.
Yes,
Don't
make
let
me feel
forget.
better.
I will. First, let's talk about the nuts and guts of this thing. First thing is you need to know what your Social Security projection is. So they used to mail out
Zero.
paper forms. No, you've probably got a really strong one, actually. They used to mail out paper forms. I don't know if they do that or not anymore. The easiest way is just create an account on ssa.gov. And then you can go and look at your Social Security projections. You have to have earned a total of 40 credits. You have to have earned money, some type of wage for at least 10 years to qualify. And then it'll give you a projection. And you'll see, for those of y'all that are maybe new to the Social Security discussion, you'll see where you can start claiming in your 62. And then you'll see where you'll hit your full retirement age at age 67. You'll see where the thing tops out at age 70. You'll see all the things that I'm talking about. It'll give you an idea of what to expect. Now, remember, those projections are not set in stone. In fact, between cost of living increases and just inflation adjusted to the Social Security measures, generally speaking, we've seen those Social Security projections increase over the last handful of years, right? And then second, my opinion, Michelle said, yeah, easy peasy. I mean, if you wanted it easy and you're worried about losing out on money, if you have fear of missing out on your Social Security benefits, just claim it as early as you can. Now you've, bird in hand, two in the bush kind of thing. However, we always recommend that as part of our investment management services, we're going to do a detailed comprehensive financial plan. We're going to look at all of your other income. We're going to look, is there a pension? Is there 401k qualified plan? Is there additional savings after tax? How many buckets of money do you have? What does that mean to our Social Security projection? When is it the optimal time to actually claim that Social Security and stick the landing on when you want to retire and maximize the benefit over a long period? It's an involved conversation that we have, and I think it's probably one of the more valuable things we provide as financial planners is helping pre-retirees and retirees figure out when is the best time mathematically to claim my Social Security, right?
Okay.
Now, to answer your question, crystal ball, big mouth here, right?
That's another segment.
I know, but when it comes to Social Security, I think one thing is important to remember, to keep the thing the thing. In the history of mankind, there has been no greater destruction of poverty in senior adults. There's been no program that has been even remotely as successful at eliminating poverty for older people than Social Security, period. I mean, back when, some of y'all that are older listening to this show, you remember the years before Social Security. I mean, old people a lot of times had to move in They had to be, had extended families. They didn't have any more income. Maybe they didn't have the health or the physical ability to make any more money, and they had no guaranteed source.
I feel like that's happening again because people are probably retiring too early and not anticipating living as long.
Well,
and they run out of money.
And so, again, we talked about this on a previous episode. I think that it's going to be almost political suicide to try to make too drastic of a cuts to it. However, you have to address the reality of math is math. Social Security has a funding issue. Now, you can do that through policies that take away, right? And there's some argument to be made on means testing. You know what I mean? Means testing is, again, another political hot button. But, if you got somebody who's a multimillionaire, do they really need Social Security?
No.
Now, they would argue, I paid into it. I deserve it. And that's an argument. We're not going to solve it here on
I've been
one
paying
episode.
into it all my life because I've been working since I was about 14 years old, but I don't think I'm going to see any of it.
But... And with that, but in my opinion, is what you want to do is incentivize people to work longer, because the fact of the matter, there's two facts that are indisputable. One is people that were age 62 in 2025 are on average much healthier and youthful than age 62 2 generations ago. It's not 3 generations ago when Social Security came in. Back when Social Security was founded, the average lifespan of a participant after receiving Social Security was 5 years. Now it's decades.
Yeah, sure.
Right? So, hey, we created
only 5 years.
The United States government created this issue. People are not only more youthful, there's more opportunities for them to continue working, and they tend to live longer. So there needs to be some type of incentive that rewards them for delaying and working longer and contributing longer. That's one of the ways that you fix it.
Yeah. Another interesting, you're talking about numbers and math. It did read that 31% of income for people 65 and over today is Social Security.
Right. Again, the most successful program in the history of mankind for keeping older people out of poverty, period. Point stop.
Right.
That's why they'll have to figure out a way, because America's not getting younger. It's getting older.
Oh, yeah.
Yeah.
Right.
Yep.
Okay, our last article is from Yahoo Finance. It always cracks me up that Yahoo's still a thing. But anyway, it's titled 7 Dangerous Assumptions That Can Quickly Kill Your Retirement Savings. Dun, 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 dun.
Mm-hmm.
The article details common assumptions by folks entering into retirement, such as they will live an average lifespan, stay healthy during retirement, or that their expenses will decrease. I chose this article because I had a couple of questions around something you mentioned with our last headline, comprehensive financial planning. First, can your planning software really accommodate all of these unknown variables in retirement, especially the bad stuff? And if so, how do you keep it from being just a total Debbie Downer when discussing it with your clients? I mean, because hearing about Social Security, it's a Debbie Downer for me. But sorry, Mr. Client, this is you. Sorry, Mr. Client, according to my software, you're going to have to massive heart attack within 5 years. And as for you, Mrs. Client, it says that you're going to lose all of your money to a crypto scam within 24 months. You're both kind of screwed, but here's my bill. Have a nice day. Is that how it goes down? Because that doesn't sound great.
Well, so a couple of things.
Are there formulas that
Yes.
go in there for health stuff and whatnot?
Yes, there is.
Okay.
So there's a couple of really important points with this, right? First, the modeling software that we use, the financial planning software we use, is intended to give you mathematical probabilities. That's what it's intended to do. It's intended to take into certain accounts. It even factors in the most likely scenario of an extended healthcare event at the very tail end of your life. So it puts these things into place. It also gives us opportunities. Not only are we, when we're doing financial planning, are we working towards planning for the upside, the investment growth, the income generation, all the fun stuff, if you will, from working so hard all your life. But it also gives us an opportunity to look at the risk management, particularly with Jay Stubbs' involvement. We're going to look at, hey, does a long-term care plan make sense in this to protect you against huge expenses, like in the case you just mentioned of a massive heart attack 5 years in, things like that. It's going to look at, do we need life insurance? If we do, how much do we need? Is there a need if I'm still continuing to work? Is there a need for disability income? What are the risk management things I need to do to hedge against if things go great, my plan works great, good for me. And I like Jay said on the last episode, if I birdie putt on my 18th hole and I drop dead of a heart attack and I win, great, right? But for most people, there's going to be some type of issue as we get older, right?
Mm-hmm.
It's just part of it. What we typically see in our modeling, one of my favorite things that my software does is called the retirement spending smile.
Oh, yeah.
What does that mean?
It's a graphic.
That means that saying that your expenses will go up or down in retirement is an unknown. What we do know from tons and tons of data And from history is that, generally speaking, when you first retire, you're going to spend a little bit more at the beginning of that retirement.
Because you're partying?
Well, because you're settling into a new life, right? You've got more free time.
I don't want to cook any. You don't want to cook anymore. You're going out all the time.
I might. Yeah, you're eating out more. You're traveling more. Hopefully, you're doing all these things. Then you get in a groove, and as you get older, you get a little more sedentary, and your spending dips down. So if you're picturing this on the radio, you're on the highs on one side. Now you're coming down, and then towards the end of your life, more often than not, mathematical probability, your spending goes up because you've got a healthcare event to deal with at the end.
And you can't take it with you.
It's called the spending smile, and it makes a big difference when you're planning for this stuff. So these are all things that we incorporate into it. But at the end of the day, it's math. The thing that I think that gives me comfort when we're talking about if AI is going to take over all our lives, and my job in particular, is that there's no AI machine on earth that has my personal experience and the things that I've been through and the common sense. You know, I'm not old. I'm actually relatively young for this business, but in the whole scheme of things, I am squarely middle-aged.
Yes.
And I've lived a lot of life. And so we can take the common sense human element and add that to all this math. And it doesn't mean that's going to be a perfect thing. We have no perfect projection, but you're going to feel like you addressed as many relevant risks to your retirement as possible. At least that's what my financial planning clients tend to give us feedback.
All right.
So, yep.
Okay.
Very good. All right.
Okay.
Is that it?
That's it.
All right. Well, listeners, I hope you learned something from our discussion around these recent financial headlines. It all matters to your money. Speaking of money, if you'd like to start the conversation with us about your investments and retirement planning, you can call us 251-327-2124 or go to our website, gulfcoastfa.com. On our site, blue button, upper right-hand corner, you can click that. That'll put either a 15-minute conversation on my calendar, 30-minute Zoom, or a 1-hour in-person meeting at any of our 3 office locations. Again, that's downtown Fairhope, that's Orange Beach off Canal Road, or in Mobile near the intersection of Dolphin Street and I-65. Either way, just reach out to us. We'd love to meet you. All right, folks, coming up next, Josh's crystal ball and big mouth. What have been some of my predictions? Have I been right? Was I ever wrong? How wrong? What do I think is going to affect investors in the near future, maybe the distant future? We talk about all these things, poke a little fun at my big mouth. Stay tuned. Welcome back. Your host, Josh Knoll, here, alongside co-host Michelle Lee Melton. So I am opinionated. I have strong opinions at times. I would say a radio show host that isn't probably wouldn't be very interesting to listen to. And I'm paid in my profession to offer professional guidance and opinions to my clients. Otherwise, what use would I be? Just replacement AI, like I said earlier. I do like making predictions, and I feel like I'm usually proved right. But there are times I swing and miss. So if you want to hear me eat a little crow, let's get at it with Josh's crystal ball and big mouth.
Okay. A little bit about AI, though. I have been listening to people, and some of them were comedians, but it was on Wait, Wait, Don't Tell Me on NPR, because NPR used to exist, but now it's unfunded.
Right.
But one of the guys got in an all-out, drag-out argument with AI. And AI took on emotions like, "Oh, I'm so sorry. I shouldn't like it."
That's hilarious.
And then he felt sorry for the AI thing, and then he kind of took back what he was crawfishing of the mean things he said to AI. It was just hilarious, but true. You know,
right.
I mean, it's crazy. Okay, so. All right. So, Josh, you stated publicly that the efforts of Elon Musk's Doge would not result in significant federal budget savings, and that it's all jazz hands for Musk to remove regulatory obstacles to his various businesses while collecting valuable data on millions of American citizens, and that the backlash would eventually force Musk to exit stage right. And while you were optimistic that tariffs could spur more high-value manufacturing on American soil, you were skeptical that U.S. investors and consumers would be willing to endure the mathematical certainty of high prices and potentially higher interest rates, a phenomenon called stagflation, that American hasn't experienced since you and I were little elementary brats. So, how are those two predictions working out so far, in your opinion?
Well, it's anything we talk about with that is always funny. It's like
it's funny.
It's a political football we got to be careful with. But
correct.
I think this is fair to say. From their own numbers, they cut about $150 billion of the budget. Okay, fine. And who knows if that's even real money or not.
I mean, and then when was that done? I mean, because they're fired, they're not fired. It's reinstated. It's
fair.
That just happened again today with a judge. I mean, a federal court.
Well, and also too, I guess breaking news on the tariffs. But the stated goal, to remind you all, was $2 trillion. So on that particular prediction, I was dead right because Musk was absolutely kind of, I don't want to say escorted, but he saw the writing on the wall.
Yeah.
He needed to get out
He's
of the
not a
spotlight.
dumb person.
You know, here's the thing, folks.
He acts like a spaz a lot, but he's not a dumb person.
Correct. Here's the thing. Unless people are willing to cut entitlements, like we talked about earlier with Social Security,
Boo.
or cut military spending, or just stop paying the interest on our federal debt, those three things, which you're talking now, I don't know the exact percentage, but it's 80+%, those three things I just listed of our total federal debt, if not more, taking a chainsaw to the remaining, the discretionary spending, was just jazz hands. Side note, do you think he actually has ever operated a chainsaw?
Elon?
Yeah.
He doesn't even know what one is. I mean, I haven't either. I'm terrified of him. But no, I mean, this guy, that's why he invented the Teslas. You don't have to drive. He probably never driven before.
That's funny.
Yeah.
Because I use chainsaws a lot, especially growing up. When he had that thing, I thought, I wonder if he knows what he's doing there. I hope somebody took the chain off.
That's right. I'm sure they did.
Yeah. So, listen, as we've said many times on the show, looking to eliminate waste and fraud, yes, everybody agrees with that. But how they went about it and the ultimate result of it, and I know some of you guys are really into the Musk and the Doge thing. You would argue, well, they're not done yet, fair. But without his notoriety and his energy behind it, I think you're going to see that fizzle out quite a bit. It's just hard to cut this stuff. It is, especially when you go after things that actually trickle down to the average everyday person, which is what we're seeing now. On the flip side of that. Both Jay Stubbs and John Luke Tyner were more optimistic on tariffs than I was, but I had some optimism because I do agree with there. You can absolutely look at the last 20 years, and you can see where when we welcomed China into whatever that organization is, which allowed for more free trade, you can see the percentage of manufacturing capacity and production in the United States has plummeted since then.
Sure.
That's a true statement,
Yes.
right? And the way I look at it is this. I don't know if this is a good story or not, but I'm going to tell it. Charles Barkley.
Love him.
You ever heard of this story? He tells a funny story about he almost got mugged one time in Milwaukee. He's out in his words, three bodybuilders cornered him in an alley. He's totally outnumbered. And he thought, well, the only way I'm going to get out of this thing is I convince these guys that I'm crazy. So he stripped down naked.
And it's cold. Milwaukee.
It was in the middle of the snow. He stripped down naked, convinced them that he was nuts. I'm assuming they didn't recognize him, or maybe they did recognize him and thought he had a bunch of cash on him. And he actually survived it and lived to tell a funny tale of how he acted like a total lunatic to get out of what could have been a pretty tragic situation if it had gone too badly. And on top of that, Michelle, he did a Karate Kid impersonation, which is hilarious.
I'd like to see that.
Now,
Not naked, though.
Not that President Trump stripped down and acted crazy in a back alley, but I do think that he did convince China he was a little bit crazy. And depending on, again, if you all read multiple news sources, you'll get a feel for how different sides are determining who won from this.
Yeah.
But I do think that there was a realization on China that they had to figure something out because they were already seeing dramatic closing of manufacturing in their country. That is true. Now, I hope this all works out, and I hope we do make things. I don't want us to be making $2 T-shirts. I think that's a waste of time.
Right.
But I do think that we need to concentrate on being able to make things. Well, listeners, I hope you enjoyed a peek into how I form my opinions and make predictions. We invite you one last time, if you'd like to have a no-pressure, no-obligation conversation about your investing goals and retirement dreams, give us a call, 251-327-2124, or visit our website, gulfcoastfa.com. On the site, blue button, upper right-hand corner, click on it, 15-minute conversation over the phone, or 30-minute Zoom, or 1 hour in-person meeting, any of our 3 office locations, Fairhope, Orange Beach, or Mobile. All right, folks, that's it for us this week. I want to give a huge thank you to my lovely co-host, Michelle Lee Milton.
Yes.
Thank you to our show sponsor, that's Providence Partners and Mr. Jay Stubbs. Thank you to our 2 awesome radio stations, that's FM Talk 106.5 out of Mobile and WHEP 92.5 FM and its sister station 1310 AM out of Foley. Many thanks to the provider of our show music, that's local band Sloth Racer, Michelle's favorite animal. Saw him in Costa Rica.
Yeah.
Yeah, we did. Huge thank you to our show producer, that's my son Peyton Null. And as always, my sincere appreciation for all of you out there that have been listening and joining Michelle and I on this journey.
Vote for us.
We'd love to be part of your journey as well. Remember, votenappies.com. Let's win this thing.
Yeah.
Till we talk again, have a wonderful and productive week. This has been Coasting in Retirement with Josh Null. Gulf Coast Financial Advisors, LLC, known as GCFA, is a registered investment advisor offering advisory services in the state of Alabama and in such other jurisdictions where it is registered, filed the required notices, or is otherwise excluded or exempted from such registration and or notice filing requirements. Registration does not indicate or imply that GCFA has attained a particular level of skill or ability, nor does it constitute an endorsement of the firm by the Securities and Exchange Commission, the SEC, or any other state securities regulator. The Coasting and Retirement Radio program serves mainly to disseminate general information, including those pertaining to GCFA's advisory services, together with access to additional investment-related information, publications, materials, and links. The publication of this radio show should not be construed by any client and or prospective client as GCFA solicitation to effect or attempt to effect transactions in securities, nor should be interpreted as GCFA providing personalized investment advice or any type of professional advice for compensation wherever this program is broadcast. Any subsequent direct communication by GCFA with a prospective client will be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. Certain information, news stories, headlines, data, charts, graphs, figures, or statistics presented on this radio program may have been obtained from third-party sources that are believed to be generally reliable, but which GCFA may not have independently verified. GCFA does not and cannot guarantee the timeliness, accuracy, or reliability of any such third-party information and undertakes no obligation to update or correct any information that may become obsolete, unreliable, or inaccurate. This radio program also contains the opinions, views, and perspectives expressed by Josh Knoll and any other GCFA representative, which are solely their own and do not necessarily reflect the opinions, views, or perspectives of GCFA as a firm. Such personal views and opinions should not be construed as endorsements or professional advice from GCFA. GCFA makes no representation or warranty regarding the accuracy, completeness, or reliability of any information on this radio program and disclaims any liability for any direct or indirect loss or damage incurred from using or relying on such information. GCFA and Providence Partners are not affiliated, nor are any of their respective representatives.